The stock market has been crashing off of a cliff recently, but I found an interesting signal that has not been triggered for a very long time. And in today's video, I am going to tell you why I am buying this dip pretty aggressively and plan to continue to do so if it does go lower. Let me show you. So there's no question, we are in a big bearish move here in the stock market in recent weeks. We've seen a pretty dramatic crash, and I believe I heard somebody say that this is the 5th quickest sell-off that we've had in market history, which is saying something. I mean, a 10% decline in just about 20 or so days is pretty impressive. And so the question is, a lot of people are wondering, is this just the beginning? If you have such trajectory, is this just going to be one of these kinds of moves where we just have a dramatic fallout in stocks and we flush out all summer long? Today, I want to give you a few reasons why I think that that is not likely to happen and why I think that this is actually a wonderful long-term buying opportunity in my personal opinion. And I do want to clarify that this is not financial advice, and I could be wrong about this, but I don't think I am. The first bullish reason that I want to defend here is that the headlines have everybody terrified. It's hard not to be. If you start reading around what's happening on the internet, oh my gosh, tariffs are going to crash the stock market. It's pretty dreary out there. And the headlines would have you believe that by tomorrow, the market will be at zero.
Passengers certain to die. Airline negligent. There's a sale at Penny's.
But what I want to really point out here is that we can see it in the data too. People are being sold and convinced that the market is going to crash massively. When we take a look at the put to call ratio, what you can see is that people are out there paying massive premiums to buy puts, aka bearish bets on the stock market, and believe that from here there's going to be a dramatic decline. And this is why I think people are setting themselves up to absolutely lose a ton of money in this market. Now, when the put to call ratio gets this extreme, that's telling you that everybody is lining up with their cash in their hand to buy puts on the market. And when everybody wants to buy something, as you can probably imagine, the cost for those puts goes up dramatically. Now, when you buy bearish bets in the forms of puts, you're betting that the market has to drop dramatically for you to get any sort of payout. And when this put to call ratio gets very extreme, you're already in the hole a ton of money when you buy those puts, and you need the market to seriously crash to make any kinds of money. But the market isn't designed for the masses to make money. It is designed for the smart investors and traders out there to make money over the long term by staying patient, disciplined, and finding proper setups. But what we see right now is people are full port buying puts and betting that the NASDAQ, the S&P 500 stocks are going to just drop out of the skies. To back up this sentiment claim, here is the topic of the day. In the topic and the title of the video, I mentioned this hasn't been triggered in a very long time. We have recently seen the most extreme AAII investor sentiment survey report that we have seen since the great financial crisis in 2008. Now, let me ask you, which one of these sounds more real in terms of a massive problem? Tariffs and trade negotiations, or the banking and the financial system on the brink of complete collapse? You let me know what you think sounds more scary, but I'm going to go with the latter. The financial crisis is no joke, right? That was a massive, 2008 was just horrible. It was ugly. It was terrible. But to think that we are seeing similar type crowd mentality, and again, people absolutely petrified of what's going to happen next in the markets, fear is everywhere. And in my opinion, that is what is setting up such a beautiful opportunity to trade contrarian to the crowd and actually look for some long opportunities. Now, before I continue with other features that I think support this case for a possible bull market rally from here, I'm going to just mention that if you'd like to access the tools that I just went through and the sentiment data tracking tools specifically that I just went through, you can find all of them in the Edge Finder. And if you don't already have a copy of the Edge Finder, I'll leave links and promo codes in the description down below. And if you speak directly to our support team using the first link in the description, you can get an extra discount just for your time speaking with our team. Another contrarian symbol is the Bitcoin to gold ratio. What we see here recently is that people are absolutely loving gold and selling out dramatically of cryptocurrency. And we can see that in the price action of gold, which I'm long, by the way. From a trading perspective, I think that this fear, this pandemonium has generated some really nice trend following opportunities that I'm looking to continue to take advantage of. But I do have a trailing stop, so if this completely erases these gains, I'll take my wins and move on. But this is just another indicator of fear in this market. People are very scared and rushing to gold and buying puts aggressively in the stock market. Meanwhile, Bitcoin has gotten really crushed here. From peak to trough, we saw a sell-off of just about 30%. And so what I've been seeing recently all over social media is people are saying, I'm going to sell or even short stocks here because I know they're going much lower. Why would I hold on to my stocks if I know they're going much lower? And the answer to that I would give is that you don't know that stocks are going much lower. And that argument is what And that argument with yourself where you say, well, I'll just sell them now because I can get them back at a better, lower price later. I'll buy them back for sure, just when they're lower. That argument internally is what causes people so often to sell at the worst possible times and to chase at the worst possible times. A few weeks ago, people couldn't get enough of the high-tech, high-value, expensive stocks like Palantir and Palo Alto and all these companies that are truly great, innovative companies. But people couldn't help themselves but rush to buy them at the worst possible times. Now that they've dropped by 30%, many of these names, people are terrified and selling them and saying, oh, I'll just buy them back later. Again, I've been on this trading, investing journey for the last almost a decade, 8-9 years, and I've seen this time and time again. People get so scared at the worst possible times, and they get so greedy and euphoric at the worst possible times. It's why sentiment indicators, like I just got done showing you, are something that I have taken upon my company's effort to build some of the best tools in the market for that. Because again, it's really important that you don't do exactly what the crowd is doing at the worst possible times. We can see the NASDAQ is bouncing here. And when we take a look at price action, here is some of the more confirmation signals that I'd be looking for on a technical basis for the NASDAQ and the S&P 500. We have lost on the 200-day moving average a key level of support and that long-term average. So what I'm looking for here from a price action perspective is a break back above some of these key levels of what has now turned into resistance and that 200-day moving average being recaptured. From a trading perspective, that's what I'd be looking at for possible momentum trades back to the upside. But beyond just the technical short-term momentum trades that I'm looking for, from a long-term basis, I actually love the idea of accumulating shares. And that is what I have been doing myself. I've bought several stocks that I like for the long term. I bought Amazon at 20+% off. I bought Google, again, from peak to trough here. We've had a pretty good sell-off on this one as well, 21% or so. So I'm buying these names and adding them to my portfolio after everybody's starting to get so scared of these names. Now, again, I'm not saying that the stock market can't go lower in the short term. From a short-term perspective, I'm not looking to trade this on the long side, but from a long-term buy and hold perspective on some of the key stocks that I like, this is a great time in my personal opinion. And as always with my videos, these are not financial advice. I'm not here telling you what you should do. I'm just sharing my opinions on the market. But Nick, don't you think that tariffs could send us into a major recession? They might, and they could, and maybe we will enter into a recession. But my perspective here on the sentiment stuff that I'm really trying to drill in is that if everybody believes that we're going into a recession, like they did, by the way, in 2022 and 2023, it actually presents some excellent risk-reward opportunities if the masses are actually wrong about that. But there are some other things that are very positive in this market right now. For example, some of our inputs to the economy are looking a little bit more attractive. What I mean by that is that inflation has actually cooled in recent times. Let me show you the data for that this week. If we zoom in over here, you can see CPI year over year came in at 2.8%, down from its recent 3% high, right? So we saw 3% down to 2.8%. This was better than expected. And the producer price index also gave us a nice signal here this week with the 3.2% reported number as opposed to the forecasted 3.3. We saw soft inflation data on both the CPI and PPI. And also helping out the consumer, which is an area that people are very worried about, is oil prices. We've actually seen in recent weeks, oil prices have dramatically fallen. And why is this important for the consumer? Well, think about it from a perspective of you go to the pumps and your gas prices cost you $60 versus now they maybe cost you $45. That may not sound like a lot, but across an entire economy, lower gas pump prices are a positive thing for the consumer's state of mind. However, tariffs do continue to really scare people, and we saw that this morning with the University of Michigan's Consumer Sentiment Report. And here it is. The consumer sentiment came in at 57.9 compared to forecast 63.1. Consumers reporting that they are a little bit more worried about outlook and that they're not feeling as good about the economy, which that is a valid concern. But what we've seen so frequently in markets is that people report what they're feeling very differently than what they actually do, right? The actions of the consumers are ultimately what matters, not just necessarily how they're feeling anecdotally. Now, can it materialize in their actions? Yes, but that is yet to be seen. And many people are right now, but both from CEOs down to everyday consumers, a little bit worried about what's happening with the tariffs, and rightfully so. They could cause some serious changes to the way our economy functions. But my whole point with this video is that everybody has rushed to one side of the boat, assuming the worst. And I actually had a conversation with Kenzo about this very matter. We talked about how, again, as if going back a million years when we're getting chased by a lion, human beings have a tendency to seek out the worst possible scenario and make that their base case, where markets oftentimes do not realize the worst case scenario, but instead fall short of those worst fear outcomes. But before we hear from Kenzo and I's conversation, I wanted to mention today's video sponsor, 8cap. If you are not already trading with 8cap and you live outside of the United States, this is one of my favorite brokerages. They've been a long-term supporter of my work, and you can actually get a free copy of our software with 8cap if you make a certain deposit tier. If you want some information about that, head over to a1trading.com/8cap. That's a1trading.com/8cap, and you can find out more information about this special offer that they have with us, or you can just check out 8cap in the link in the description down below. 8cap allows traders to trade everything from CFDs to foreign exchange to cryptocurrencies, all in a singular brokerage. So check them out in the description down below. Kenzo and I discussed at length this concept of people being more fearful about what could happen more often than what actually tends to happen in the markets. Check this out. A couple things that I think are actually quite bullish about this market right now. First of all, sentiment is extremely skewed in terms of the bears. So what I mean by that is that if we go over here and we just take a quick look at what the crowd is thinking, first of all, the put to call ratio just went parabolic. So everybody on the options market is buying puts. They're buying protection. They're buying insurance. They're terrified of where the market is going next. People are convinced the stock market's going to crash. That's what the crowd, that's what the herd is thinking right now. At the same time, take a look at the AAII Investor Sentiment Survey. This shows you what investors report on their kind of feelings about the market. And what we can see here is we hit for the first time, by the way, check this out, Kenzo. This is the first time that we've had 3 consecutive readings this extreme since 2008 in the financial crisis. That is how scared people are. People are reporting feeling very, very bearish on this market. So to me, sentiment is extremely, extremely one-sided. Everybody thinks the market's going to crash, at least the vast majority. At the same time, a lot of people think that the recession is in, that we're going to have a huge fallout in the economy. But the bond market is saying, no, 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 because the bond market is saying yields have not, in a recession, right? What happens in a recession? Yields plummet as the bond market says, you know, oh my gosh, we've got a disaster. In 2018, people were seriously fearful about a recession. And you see, that's what the bond market does in that time. It completely, yields completely drop off of a cliff. So the other thing is that, just going off of sentiment as well, the VIX has gone parabolic to the upside once more, showing that everybody, like I said, is pricing in, thinking that there's going to be huge volatility and huge drops to come. And then we had good inflation data this week. And then the last thing that I'll mention, and I want to hear your thoughts on all this, I know I'm throwing a lot at you, is that if we look at the economic heat map, which we talk about regularly together, most of these indicators, we added a new feature, the stocks impact feature, or the US dollar impact feature. And then we summarized it at the bottom to keep it easier for our users. And what you can see here is that we have a mixed report for stocks. Now, that doesn't mean that the stock market has to go up or down. It was a mixed report, means it's mixed. So if everybody thinks it's going to crash, but the data is actually kind of mixed for stocks, there's a divergence. So that's what I wanted to share with you. What are your thoughts on all that?
Yeah, I can say there is enough possibility for the market to reverse.
Hmm.
Because I think when we have bad news in the market, let's say the tariffs and stuff like that, mostly the market will sell off. And on the news, it seems like to be a bad news, actually bad news, because we already saw the sell-offs. But if we check it on the other side, it was necessary for the market to sell, and there
Yes.
is enough reasons to say the market might go up. If we checked previous, let's say, four economic events that we received, mostly they were cooling off, which means inflation is not really as crazy as we thought, and which means we expect indices to perform very well with the lower inflation.
Hmm.
And yeah, I think the panic is going to be there, but when we check events, fundamentals, everything supports that reversal. Because if we check the real reason why maybe we saw the sell off, it's not like maybe there is a bigger company like maybe Nvidia not performing very well. It's just the panic from the tariffs, panic from other external things,
Hmm.
which they don't really have. I can't actually, they have an direct impact, but it's not like 100% direct impact that can affect those mega companies. Yes, there will be price increase here and there, but the performance will still be there. And I think the business will just go as usual, because tariffs now, it's just getting popular, but tariffs, they've been there for a very long time. So I think yes, there is still that room. Now the market might still struggle around that level. There is that still a room to reverse, but I think it's better to wait a little bit.
And gold has recently continued its monstrous rise in recent years. We see gold breaking through all-time highs. I'm currently still long gold and trailing a stop. But today on the Market Insights podcast with Johnny Hart, I actually discussed a little bit of why gold might be rushing higher off of these tariff fears that we've been recently hearing about. Check this out.
Firstly, I wanted to ask you about the price of gold, which has today, for the first time, hit the $3,000 per ounce mark. So quite a big moment in history.
Yeah, no, it's been a huge period of gains for gold here recently. Actually, we just a few, at the end of the year, we were right around $2,600 an ounce on spot price, and you can see, like you said, hit 3,000 briefly here this morning. We've given back a little bit of it, but again, just a massive run up on the price of gold. And you listed some of the good reasons for why that makes a lot of sense. A lot of people are uncertain about the state of not just the U.S. economy, but the global economy and the shifts that are taking place with the Trump tariffs that we see going into place in recent times. At the same time, you have continued central bank buying. China reiterated that they're back on the buying train, and not to mention with the tariff situation, a lot of gold imports have been rushed across the border in recent months, actually coming from where you are, Johnny, from the Bank of England. A lot of gold transactions and purchases. So very interesting time specific to the gold market. But if we kind of take a bigger picture too, it's also the weakness in the dollar that we've seen. We've seen, a lot of stuff pointing towards a weaker dollar here recently. Some of the unbeatable economic prints that we've had in recent times from the U.S. economy have started to slow down, and showing they're not completely impervious to the effects of a slowing consumer, rising prices, and perhaps some shifting geopolitical situations across the globe.
Indeed, and there are many traders out there who are suggesting that the upward momentum for gold is not yet exhausted, and the price per ounce could rise further. Since we last spoke, I think it was on Wednesday, Nick, we've seen more tariff trouble. US President Donald Trump threatening a 200% tariff on any alcohol coming to the US from the European Union. And that was in response to the EU's plans for a 50% tax on imports of US produced whiskey. So obviously the tariffs are a big part of this uncertainty and the flip-flopping that we see from one extreme to the other on an almost daily basis. So people out there are probably thinking that gold is the safest bet at the moment.
Yeah, it's interesting. I mean, you bring that up. What that plays into is this recent thought that maybe all of this tariff stuff was a bit of a negotiation tactic. And while it still might be, it seems like Trump is pretty serious. I mean, he was actually pressed by a reporter yesterday, and he did not back down at all. He said, if anything, there was basically more room to be more aggressive on tariffs. So again, like I said, a lot of people kind of thinking that this was a negotiation tactic, art of the deal, 101, but it actually seems like Trump is very serious about the tariffs and that they are set to move forward on that April 2nd quickly approaching deadline for many of the reciprocal tariffs that we're expecting as well. Many traders don't know this, but a lot of trading profitability is dependent on you using the correct brokerage when you're trading. Remember that your trading costs are an input to your trading results. So what I mean by that is trading costs such as commissions and spreads and swaps and overnight holding things, all of that plays into your final results as a trader. And another huge thing that I cannot emphasize enough is you making a deposit into a brokerage account can earn you some significant trading perks if you use the right offer links. In the description down below, we have put together a collection of some of our partnered brokers that offer welcome bonuses when you make a deposit, free stock shares when you sign up, and access to some of our products for free. On our website, a1trading.com/brokers, that's a1trading.com/brokers, you'll see a list of free offers that you as a client to these brokers can get upon sign up and deposit. Do not make the rookie mistake of just signing up for any brokerage and not using a specific offer link. If you use our referral links, you'll get something out of it, and you'll also be supporting our work here on